Hey folks, Chris Versace from Tematica Research. Today is Monday, October 28th, and this is what we're watching in the week ahead. Setting the stage as we move into the final week of trading for the month of October. Hard to believe. What did we see? Well, last week the Nasdaq Composite hit a fresh high, and the S&P 500 closed out last week trading at an eye-popping 24.3 times consensus 2024 earnings. Looking at those data points alone, it's fair to say that as we kick off this week, expectations are running high. And they're running high as we have more than 900 companies reporting over the next several days, 169 of which are S&P 500 constituents. That means that this week alone, 34% of the S&P 500 is going to report. It's going to be a litmus test on consensus expectations for 2024. We could also see some movement in consensus expectations for 2025. On top of that, across those 900 companies, we are going to have nearly all of big tech reporting this week, notably Google, Microsoft, Meta, Apple, and Amazon. Collectively, those five stocks alone account for roughly 23% of the S&P 500 and nearly 30% of the Nasdaq Composite. What does this mean? Well, in a week that has a sea of earnings, those figures explain why the market will be focusing on those reports pretty much above everything else, and how they come in, the guidance that they give relative to consensus expectations. That's going to influence not only the market's direction, but also those consensus earnings expectations that I just mentioned for the back half of 2024 and potentially for 2025. Now, leading up to these five reports, we've had a lot of favorable comments about AI adoption last week. IBM talked about a $1 billion sequential improvement in its AI-related bookings. ServiceNow delivered wonderful numbers, and there were others. This week, as those five companies report, we'll get more comments on AI adoption, but we're also going to get comments on cloud growth as well, AI and data center spending levels, smartphone sales, digital advertising, and let's remember, it is an election year, and last I saw, both candidates dead heat. I wouldn't be surprised if we see a lot of extra last-minute digital advertising relating to the campaigns really come on stream. But in short, it is a big week for tech, as well as several of our models here at Tematica. Now, at the same time, we have also started to see the market expectation for rate cuts start to soften a little bit. Between now and June, recently the market had been expecting 25 basis point rate cuts. But coming off of last week, we started to see that soften a little bit, 4, maybe 5, 25 basis point rate cuts between, again, the Fed's November meeting and the culmination of its June 2025 meeting. What's kind of spurring this rethink? Well, a lot of it has been the economic data of late has been far better than expected. The Citibank Economic Surprise Index, better known as the CESI, is back in positive territory. That tells us that the data is better than what the market was looking for. But we can also take another look at the Atlanta Fed GDP Now model. This is this rolling GDP forecast. And for the September quarter, it's still sitting around 3.3%. That's much stronger than what people were thinking the third quarter was going to look like in July and in August. But to that, we can add what we saw last week with the flash PMI data for October. And it clearly showed the strength of the economy moved further into, or I should say continued into the month of October. And when we look at the new order data, 17-month high, it suggests that we're likely to see that continue into November. Now, that's the setup for when we get a couple key pieces of economic data this week. The September PCE price index, which should show further improvement in inflation. And remember, the PCE price index is the Fed's preferred inflation metric. We'll also get the ADP employment change report and the October employment report. Now, as it relates to those two employment data points for the month of October, the October flash PMI found only a modestly slower rate of job growth compared to September. And remember, when we got the September employment report, that figure at 254,000 jobs was way higher than anybody was expecting. And this means we really have to take a look at the consensus forecast for the October employment report. Currently, it's somewhere between 110,000 and 140,000. A big drop compared to September's 254,000. But here's the thing. If we go by what the flash PMI report has to say, we could be in for an upside surprise on Friday when we get the October employment report. Now, I do think that once we get the October ADP employment change report on Wednesday, which shows, private job creation, we might get some tinkering with those expectations for Friday's October employment report. But here's the thing. Should the jobs data continue to be robust, it would be another reason the Fed doesn't need to cut rates next week when it concludes its November monetary policy meeting. Yes, monetary policy is still restrictive, and the Fed may ultimately opt to cut rates to move policy more toward a neutral footing. But again, the need to do so based on the strength of the economy may not be there. In other words, the economy is humming. The Fed does not need to helicopter in and rescue the economy. If anything, I wouldn't be surprised if we get a good batch of numbers this week that folks say, wow, the economy is really continuing to perform. Does the Fed need to cut rates? And if they do they risk stoking inflation? So we're going to have to, once again, let the data talk to us, refine expectations as needed. But that's kind of the setup for what we see in the week ahead. And as I say, be sure to look back. We'll have a lot of signals on Tuesday and Thursday. Want you to take a look at that. But also to remember, it's Halloween. Enjoy yourself. And we'll see you back here next week.